Glad that we get to spend some time tonight to learn from one of the experts.
Yeah.
Hey Tris, welcome. I think I've talked with you before. Great to see you here. Los Angeles, Washington State, Kissimmee, outstanding. Keep it coming. Let us know where you're from. And we've got some of our team members in the chat as well. So if they're nearby, they'd be happy to get in touch with you all. Seattle, great. I'm from Raleigh, so I'm in Raleigh, North Carolina.
I'm from Northern Virginia, my friend. DC. We got Lake Mary. We got Chicago. We got Dallas, Texas, Boise. Awesome. We got another Dallas, North Carolina, Orlando, California. Welcome, guys. Welcome. I'm really excited. Keith, what do you think is the number one thing that people want to know about what's going on, and what's perhaps strategies or education or tactics that can help them get ahead in this economy in this time?
Well, I think people, I'll give you my own example. I'm an anesthesiologist in Raleigh, and I'm just looking for a risk averse investment option for myself. I keep looking at I'm guilty. I look at my stock portfolio and I was like, oh God, I don't want to look anymore. So I'm just looking for strategies to grow wealth and, take it. I've been really interested. I've been invested with real estate, but always looking for, alternative means to grow my wealth, my family's wealth, to put our hard-earned money to work.
Yep. I hear you, man. All right. And I want to present some of the latest economic data. So I think we're having a ton of folks coming on in. And this will be recorded, guys, so you'll get an opportunity to review this, or if you can't make the whole thing, there'll be an opportunity to watch it later. So that being said, let's do it, my friend.
Okay, cool. So I always love doing this, but I like to be the intro man for a good friend, Dr. Vikram Raya. So welcome, everybody. We are so appreciative of your time. We know it's difficult to take time away from your busy days. We got lots of physicians in our group. We're really, really excited to have you guys. We want to deliver a lot of value for you this evening and this night. Vikram, I know, has been working hard, as has the whole team, on getting this presentation really fine-tuned for you guys, so you can walk away with a lot of information, a lot of facts, a lot of predictions for the upcoming future. So without further ado, my good friend, Dr. Vikram Raya, is going to lead us through a talk on From Fear to Fortune, investing during economic downturns. This is something that I think a lot of us, me included, are looking for guidance on from some of the experts and some of the folks who have really spent a lot of time looking, who have mentors that are experts and are just kind of, have their finger on the pulse. So with that being said, Vic, can you take it away?
Yeah, man, let's just get right into it, guys. I want to cut to the chase. I want to deliver a tremendous amount of value, guys, to you tonight. This is near and dear to my heart because I know so many of you have worked so hard, created some nest eggs, created some investment portfolios. And, we know there's always economic cycles, but, this one feels a little different. And I just want to address basically the elephant in the room. How many of you, I want you to put in the chat box right now, what are you worried about? Here's what I see, what I'm concerned about, or what I hear my friends, family, investors, colleagues, clients tell me. Hey, there's market volatility. Dude, my crypto is not working anymore. Inflation is up. Are we in a recession? Are we in a correction? Is this going to be worse than 2008? Are there layoffs going to happen? Or how many layoffs can we expect? What's going on with my interest rates? I can't afford my mortgage, or I wanted to buy a house, but I can't afford it. It's too crazy. What's going on with this artificial intelligence? How come everyone has ChatGPT after every sentence that they're talking about? And what's going on with those drones? There's so many drones out there, right? So this is some of the language I'm hearing. So let me check in. Let me see if that holds true here. Let me check in with people in there. Is this something that you guys are feeling a little bit? Good. I see Randy talking about the future value of the dollar and maybe the lack of a future value of a dollar. Christina's talking about retirement accounts. They're talking about inflation, interest rates, right? Absolutely. Anything else people are worried about? Recession? Yes. Danielle says yes to all above. It does feel different. Absolutely. All right, cool. Let me just get back into it. So I saw this in the Wall Street Journal, guys. There's a large conglomerate that owned 3,200 apartments in Houston, multifamily apartments. They're going for foreclosure, right? People are wondering what's going on. Is this the end of times? The majority of Americans fear a recession is coming, survey says. Mortgage rates are topping 7%. And this is probably a little bit old data. I've seen 8% interest rates, in mortgages. Amazon going to lay off 10,000 workers. What's going on? Who's next? Meta, Twitter. World leaders meeting as global economy faces multiple threats, right? Even a global recession may not bring down this inflation. So that's what's going on, right? Can I add some fuel to the fire, my friends? Yes, let's do so. Here's how the second biggest bank collapse in U.S. history happened in just 48 hours, right? This was March 10th. This is about just a little bit more than a month ago. So what is going on? What the heck is going on, right? The bank failure, food insecurity, right? Ukraine was one of the hubs of wheat production in the world. Energy crisis going on, war with Russia, right? Layoffs, production slowdowns. A lot of this is going on. Some of it was, pandemic, post-pandemic, but these are real issues, and I'm not going to deny them at all. And across industries, we're seeing, of course, real estate markets are tough, and it's not just one asset class. All asset classes are having some effect. Labor markets do remain challenging. Absolutely. Recession is a potential in some industries. Yes. Equity and debt is challenging. Those are all true. And, quick one-liner. I'm the CEO and co-founder of Viking Capital, control over $720 million of assets. We've raised over $250 million of private equity. I run a couple other companies as well. We've become Inc. 5000. But I'm just saying that because I've been around, I've seen things, and it still affects us, right? Even though I feel like I have some knowledge and some experience, and I do have mentors, and I feel like I'm up to date in the studies. Yes, this kind of economic information does affect me as well. But I want to share with you where I think we're going. And I call that an economic forecast. So based on the numerous economics I speak with and some of the data and the reports and the white papers I'm reading, the rates are expected to peak in 2023. The reason for this is there's instability in some of the financial institutions. And so further rate increases will probably destabilize the situation. And the Federal Reserve will unlikely proceed in that sense. So the economic tightening that we're seeing, people are expecting at most one more rate hike, quarter of a point, half a point at most. And then we're going to have a plateau period, and then we're going to see rates start dropping. Is that late 2023, or is that earlier 2023, or is that early 2024? No one can say, but that's the trajectory. Once the downward trajectory of interest rates are there, a few things are going to happen. One, liquidity is going to open up. More people are going to be ready to start transacting, doing things, real estate, stocks, etc. Confidence will start trickling in. It's not going to be a huge tsunami of confidence, but there will be more confidence coming in. There's going to be more transactional volume. What does that mean? That means, money loves velocity. Money loves speed. If money is stagnant, no one is happy, right? The way our economy, the world economy works is exchange, transactions, and movement of funds and currency. And so this has to and will continue over time. And the final thing I'd like to say is, yes, we had a really bad 2008, and it still causes PTSD for many of us who remember it. Now, the millennials who are listening, you may not really have felt it then, so this is your first big one, and I get it. But in most economic viewpoints, this is likely to be a 2008 light. One of the reasons for that is Dodd-Frank was a regulation set up by the U.S. government to make sure that we never have that level of instability in our financial institutions. And so even though there are a lot of people have assets and perhaps mortgages have gone up, most people are sitting on equity-rich assets. Number two, people have their savings rates have really increased compared to the last economic cycle. And number three, despite what you're seeing, the US is still the safest haven for currency. I recently came back from Egypt. Man, like the US dollar is so strong there. So many other countries, the US dollar is just doing so well compared to other currencies. So you have to think of things as comparative. All right, let's get into it. Economic forecast, guys. But before I do that, I want to say something. History doesn't repeat itself, but it does rhyme. So we can predict economic climates based on the current data. And, as we know, the interest rates, as we know where things are heading, let's look at the employment here. So if you can look at here, employment during the COVID crisis during 2000, obviously dropped it precipitously. And in 2021, with all the stimulus and sort of the supply shortages, boom, it went to an all-time increase. 2022 still increased, but not as much. And 2023 we started seeing a little bit of contraction, a little bit of layoffs. But we're already seeing some predictions of a recovery in 2024, right? And that is sort of where this is based on the Bureau of Labor and Statistics, okay? Next, what we're seeing is the federal fund rate will be north of 5% in Q3. Okay, so that's the terminal rate that's where the Fed wants to take it, and they think that will help tame inflation, and then they're going to start bringing it down. The economic perception versus reality, guys. Headlines are misleading. Okay, it's fear-based marketing. So yes, did you guys? Let me ask you a question. Let me just get over to the chat here and just talk to you all. Are you guys hearing all the layoffs? Yes. Are all the layoffs? Are they concerning? You're seeing some sensational headlines. Wall Street Journal, New York Times, USA Today. There's layoffs. Yes. Yeah. Perfect. Thanks, Christina. Thanks, Ashley. Thanks, Margie. So check this out. Here's what I want to show the fact from the fiction. Okay. So check this out. Google, they showed that they laid off 12,000 people, but they forgot to mention in the headlines that they also hired an additional 68,000 people. So that's a $56,000 overall addition to the workforce. Microsoft, same thing. Actually, a positive addition of 48,000. Salesforce, 36,000. Amazon, they net positive 31,000, guys. Meta, formerly known as Facebook, 30,000 positive, right? Stripe, Snapchat, Shopify, even Robinhood, right? Twitter. Now, Twitter's real. 4,000. They let go. They only brought on 2,600. Well, we know our boy Elon. Elon Musk. He does his things his way. Well, he's trying to restructure the company. So I would say that's more of an outlier, and he's trying to make it more efficient. So kudos to him. He knows what he's doing. Obviously, he's run several multi-billion-dollar companies. You go, Elon. But that being said, everyone else is sometimes being fed, sensational headlines when the reality is we're actually a lot stronger economically. Okay, let's talk about embracing opportunities. So let's see here. Let me talk about. So remember in the headline I talked about that Houston operation where we had, I think, was it? Let me see how many people. It was 3,200 units, right, in Houston that they were being forced to sell, right, or they're going to foreclosure. So let's talk about why that is, right? The main reason why those things happen is, one, they don't have enough reserves. Number two, they didn't put into account their business plan fast enough. So when you take over a project or a real estate deal and you're doing something called value add, which is improving the property, you must do it quickly. And if you don't do it quick enough, and like for example, rates shift on you, you don't have enough income to cover your mortgage payments. And finally, if you're not effective in your operations, if you think everything is going to go up, you don't have to think about it, and you can operate sort of shabbily or with high expenditure, then you're going to get burned, right? And that's really what happened here. So why am I excited about those 3,200 foreclosures? Hello, we have deals in Houston, Viking Capital. We're excited because if those deals are on discount, which we haven't seen in almost 5 to 7 years, these kind of discounts, I'm ready. I want to go in and buy these properties in distress. And I want to implement my business plan very quickly. I want to create efficiencies. I want to negotiate good terms. If I'm buying it from a bank, for sure, they just want to get off their books. If I'm buying it from a a stressed owner. He doesn't mind shaving off most of his profit and give it to me at a reasonable price. So this is actually a time for opportunity. I hope that makes sense. Let's talk about cap rates. So cap rates are essentially a ratio of purchase price and income, right? We're not going to get into all the details of it, but bottom line is when cap rates are higher, that means you're paying less for that same income. When cap rates are lower, you're paying more for that same amount of income. And so over the years, cap rates are what we call compressed. What that means in general is, you're getting the same income for a lot higher price, and it's quote unquote more. It's just that's what the ratio is. So that being said, though, when cap rates were compressed, we were actually seeing a lot of higher rents. So here we're getting a discount on these properties, but sometimes maybe the rents are a little lower. So overall, the overall trend in terms of returns is not going to change much. But that being said, we just want to dynamically assess the situation and come in opportunistically. I would say for all of you listening, the two buzzwords I want you to write down are cautiously opportunistic. Okay, cautiously opportunistic. And I'll give you an example of this. Right, here's an example of us being cautiously opportunistic. During the quote unquote crisis, during the economic correction, during all of this, we found a deal, almost $11 million off its peak pricing. We got it for $57 million. Oh my God, interest rates are through the roof. Yes, we found a strategy that makes sense. We assumed the previous owner's interest rate. Instead of us paying 4, 5, 6, 7, forget 4, 5, 6, 7% interest rate. We got a 3.6 fixed percent interest rate. And we got in a good city, Atlanta, in a good area, good vintage, 2005, right? That's an example of things. I'll give you one more example before we move on. And I want to get into how you guys, with your current situation, can take advantage of what's going on. But before I do that, let me give you one more example. We bought a deal called Veritas. This was in 2019. And now, even with this correction, even with these quote unquote downturns in pricing, we're going to exit at a 60% increase upon our purchase price. So if Robert Kiyosaki has a really good quote. It's not the investment that's risky, it's the investor. And so I urge you all today is, as we get into the portion where we talk about your individual situation, it's time to increase our education. It's time to increase our knowledge and our experience and our strategies and tactics. So we as investors become more savvy and become opportunistic in these potentially really good times. Okay. So
this is amazing stuff. Like I love you talking about some of your previous investments, and I'm sure there's a bunch of people on the call or on the webinar that might just want to get in touch with folks at Viking. What's the best way? Is there a website we can go to? Is there a link?
Let's do that. Let's if people are interested, let's go ahead and there's a book a call button here.
I think I just pop up.
Perfect. And then, but I want to get into this thing right here. Okay. Guys, where do you think we are in the market cycle right now? And I want you to put an emotion in the chat box right now. Let's check in here and put where you are. You are in denial? Are you in fear? Or do you think we as an economy are in panic, anger? Is it depression? Where is it? Where do you think? Okay, I see fear. I see hope. I see panic and anger. So fear, panic, anger, and depression. No one really said depression. I say fear, panic, and anger, a little bit of hope. Okay, great. Thank you guys for checking in here. Awesome. And so let's get into it here. Why did I put this silly emoji chart here? Because I'm putting this on because when it's darkest before the dawn, right? It's there is, when people are here, you can't really time the market, but we're getting close to the bottom. So the moment the bottom presents itself, which we're never going to really know, but as long as the deal makes sense, you go for it. But realize this is the point of maximum financial opportunity. If you knew about 2008, when 2008 happened, how much money would you invested in real estate or in stocks or whatever else some other asset class, right? if you knew this was going to recover in 12 months, 24 months, 36 months, how much money would you have put in, right? If I had known, like I wasn't really active in 2008, I had just gotten started. I was still in training in cardiology fellowship, so I didn't know half of the stuff. But guys, if you missed out on the 2008 huge up run, this is your 2008. This is your opportunity. And so that's why I present this chart to you. So let's talk about this, okay? So I share this with doctors and clients and investors all the time, but I want to talk to you about a special number called a FIRE number. And if you know and can calculate this, it will help you unlock your financial freedom. Who wants to play? Can I get a thumbs up? Can I get a yes? Are we good? Yep, cool. Let's go. So here it is. So what's your FIRE number, right? It is your financially independent and retire early number. Okay. I'm sure you guys have heard of it, but here's how you calculate it. Figure out your annual expenses. And if you're listening to this, whip out a pen, whip out a pencil, and let's scribble on a piece of a napkin. Okay. Let's do this. Okay. And it's just an estimation. No one's going to come and check your numbers. Okay. Figure out your annual expenses and ballpark this. You know your numbers. Okay. Figure out your numbers and multiply by 25, and that's your FIRE number, okay? And let's say you want to retire early, which I think all of us want to, right? Let's say you want to retire early. Consider, instead of 25, put it to 30 or 33, okay? Multiply by 33, let's say that. If you want to retire early, multiply by 33, right? And that's your FIRE number. That's your financially independent retire early number, okay? I'll give you an example. Let's say your annual expenses is $60,000 a year. Okay, fine. Multiply that by 25. My FIRE number then would be 1.5 million. Does that make sense? Are you guys with me? Is that good? Are we good? Thank you, Sean. Thank you, Shauna. Hurry. Okay, great. All right. So now let's get into it. What's your FIRE number? So now this is basically take your annual savings number and divide it by the number of years before you should reasonably retire, and are you happy with that number, right? So let's say your overall net worth or an overall amount of money you have that's available to you, divided by how much money savings that you accumulate per year. That's how many years it's going to take to get to that FIRE number. So let me say that a different way. I think I may have confused some people. So whatever your FIRE number is, divide that by the amount of money you're saving per year, and that's how many years it takes to get to your FIRE number. Okay. So what if I could? Let me ask you a question: are you happy with that number, whatever that is, right? Your FIRE number, and however many years it's going to take to achieve that FIRE number. And if you're not, then let me ask you a question: what if I could share with you a strategy that, one, can accelerate your year to your retirement? Number two, you get profit upon sale of asset, you get tax advantages, you can hedge against inflation, you can appreciate over time, and it can create cash flow, right? You're like, oh, it's too good to be true, right? And there may be other asset classes like this, but one of the examples, as we're going to talk about, is multifamily, right? That's one of the things that can do all of that. And this is the same asset class the 1% invest in. NBA players use multifamily. Shaquille O'Neal, Emmitt Smith, all these guys actually have started to get into, they've become more savvy, and they're using venture capital and hedge funds and things like that. And they invest in large amounts into multifamily. Most of the Fortune 100, the 200, the 300, they either have made their money in real estate or you put a large amount of money to maintain their wealth in real estate. So that's why I like it. That's why it makes sense to me. And no matter what, if you look at all the world's recessions, over time, the real estate line still trends higher, and so do stocks and equities. We're just saying that it's not saying stocks and equities are not a good thing to invest in. We're just saying if you're going to diversify, this is a good thing to consider diversifying in. That's all. So what's the first opportunity? It's overall relatively recession-proof. So this is a matrix of national average rents, and this is from 2021 to 2023. So is the general trend, as you can see, is upward, right? it's very rare to have negative rents or rapidly decreasing rents for multiple years. You may have a little plateau, you may have a little bit of a stumble, but in general, the trajectory is up. Why is that? Because housing is not a luxury. Everyone needs a place to live, right? And there's more and more people being, more and more people coming into this world, and they need places to live. And I'll show you something in a later slide about a housing shortage. Next, recession-proof investments, right? So year-over-year rental growth and monthly lease renewal rates, all of them overall are trending up. Now we'll have a downward trend here, but it should stabilize and should trend up again. Apartment construction. You're thinking, oh my God, they're going to make too many apartments, at a 50-year high. Well, not really. The units completed are increasing, but overall the supply, if you look at the rate of supply expansion, is actually on the way down. And I think this headline really hits home for me, at least. They're saying America is short more than 5 million. This is from CNBC. Or is short more than 5 million units, and the builders can't make up the difference. So there is going to always be some shortage of housing, and if it's a supply and demand equation, that's why it's overall a reasonable place to park your money. Opportunity number 2, we talked about multifamily cap rate advantages, risk and return. So depending on the kind of debt you're going to get, you're going to change your risk and return profile. And that's just something to be mindful of. And opportunity number 3, I really like this infographic. So I made sure we verified it with our team and some of our accountants and stuff, just to make sure that the numbers were accurate. But it's really interesting just to see. So the stocks in the S&P 500, great place to park your money. I have my money in stocks as well. I like it. Over the past 150 years, about 9% return. Fantastic. If you took that and compounded that, over 20 years at 9%, 100,000 would eventually equal about $500,000, right? 560,000. And to reach $1 million, you'll take you about 27 years for that. Not keep investing, but just taking that original 100 and moving it forward. If you invest in real estate, for example, our last 9 deals, we exited at about a 24% average annual return. And so if you took that and did 100,000 in 20 years at 24% return, you're going to get $7 million in 20 years. And the time to reach $1 million is only 11 years. So just to show you an example of, you're going to get really strong interest rates, get tax efficiency, get cash flow, get returns, and overall ride an upward trend. These are some of the advantages there. So how do we position ourselves to climb? Well, we got to figure out overall, what kind of person are you? If you're a physician listening, we've sort of broken it down by different profession, different types of journeys that physicians are on. But it doesn't matter if you're a physician or a non-physician. The theory holds the same. So there are a lot of people who are W-2 or solo doctors, about 3/4 of you. And you're trading hours for dollars, and you're working more, you're making more, you're reading Susie Orman or Dave Ramsey, and that's great. But this, by you starting to becoming more of a sophisticated investor, it's going to really open up a lot of things. People who are what we call Dr. Scale, or people who own like one business and they want to scale to multiple locations, right? You really want to think about, developing your business skills and your capital so you can really scale your clinic, and then use that extra money to invest in things such as, in your own business, for example. And then obviously we mentioned stocks and equities, but also real estate. Doctor side hustle. These are people who they want to start something on the side. And so they have an interest outside of their main job. And so they want to learn how to monetize it, but they're not sure how. So the key for these three folks is to really focus on one other thing outside of their main profession, and then really double down on that. And there's finally people who really want to leave their current position, their current job, for example, if they're a doctor, and try something new. So the key here is, they have to overcome burnout, bureaucracy, and BS, and really specialize in something else, and make sure they have multiple streams of income to support their new venture. So let's say you achieve FIRE, right? Financially independent and retire early. What does that get you? Well, guys, it's going to get you time. That's so important. It's going to get you location independence, security, clarity on everything you need for you and your family. It gets you freedom to do your passions and your hobbies and your pursuits and your charities and your nonprofits and all the other extracurricular activities you want to do. You want to write a book. You want to travel to different countries. You want to support your church or charity. You get to do it all. And really, if I had to sum it up, it's all about options and freedom, guys. And let me ask you guys, is that really what you guys want? Options and freedom? Yeah. That's why it's important to learn this, right? It's important to really figure out what these numbers are and figure out maybe strategies so we can help you get to where you want to go. So let's create a game plan for the next 30 days, shall we? So step one, let's determine your FIRE number. We talked about the calculation for that, right? Next, let's calculate the time you need to get to retirement. Number three, let's write down the freedoms that you want to achieve, the FIRE freedoms. Number four, let's strategize an acceleration plan to get to your FIRE number quicker. Can we shave off 5 years? Can we shave off, 6 years, 3 years, 4 years, whatever it takes to get there quicker? Next is, can we increase cash flow opportunities so you don't have to always have to go into work to get your money, but you start having other streams of income, right? I've read a recent statistic. The average millionaire has about 9 streams of income. Next, can we leverage retirement accounts? A lot of people have like 401ks, rollovers, Roths that are just sitting there languishing, not doing much. Can we get those and invest in things? A lot of people don't realize you can use money like that to invest in real estate or other things if you don't have cash lying around. How do you become really tax efficient, right? A lot of you people, they earn a lot of money, but it's may not be the most tax efficient way to earn that money. So can we improve tax efficiency? And then number 8, let's calculate a new FIRE number, and because if you can get a 2x equity multiple on your investments, that can really change the story. And then finally, getting accredited. An accredited investor is a person, and if many of you are accredited on this call, that's really powerful because it allows you to have access to investments that traditional investors don't. And just a simple definition, if you guys know what an accredited investor is, it's a single person about 200K. It's a couple earning about 300K. It's a net worth of $1 million, not including your primary home. And number 10, let's collapse time and let's become free. Let's achieve FIRE and get to where we want to go. Okay, cool. And with that said, let me show you this. If you're interested in learning more, our whole goal, our whole reason for doing this is just to help you guys and brainstorm. This has nothing. If you want to find out about what we have going on, fine. But really, I want to just have this opportunity for you to talk to my team. Let's come up with a lifestyle wealth strategy for you. There's so many things that we can talk about and share with you, and we just want to figure out your current situation and see where you are, where do you want to go, and perhaps what other things that you can maybe add on or layer on to what you're doing. Okay. And I want to be able to take a few questions if you're up for it, and then we'll wrap up here. Cool.
Great, Vic. Thanks so much for going through that. That was really nice. I'd like to just add on that, the slide just before where we map out kind of a game plan, is it's really important to even just think about like a why. Like, why are we doing all this? That's what really gets you energized. That's what brought you here to the webinar. That's what gets Vic fired up to help. And, really the whole team at Viking is ready to kind of help you develop your lifestyle wealth plan. So having a great why will get you motivated to do a lot of this. So outstanding, Vikram. I do have a few questions here, and then there's more.
Let's rock and roll, man.
Read them to you. So there's a question from Rama Yada. He asked a great question. He asked, well, what distinguishes Viking and the strategy that Viking follows from other companies out there that are doing similar things?
Yeah, great. I think there are a lot of companies out there, right? Like, you look at, any company, there's so many people in any kind of space. And so I pride Viking in the fact that we're unique, we're more boutique, we're nimble. We have the scale and the capacity to really do big things, but we still have that really close investor touch. So when someone works with Viking, they're going to have so many multiple touch points. They're going to have really a white glove experience. And we're really looking out for the bottom line for our investors. Our bottom line is people, planet, profit. What that means is we're really looking to help the communities that we invest in. So we're doing, nonprofits, charities in the communities we work in. We do green energy projects and ESG strategies. And on top of that, we think about what it makes sense for the investor. Sometimes investing with us doesn't make sense for the investor. Sometimes there's other strategies we actually advocate for instead of investing with us. So for us, it's how to get you to your goal. And if our strategy is part of it, great. But that doesn't have to be that. And we also want to be a resource. There's a lot of people who come to us and say, hey, do you know a CPA that does this? Hey, do you know I'm looking to do this strategy in this part of the country where you guys are not involved. Can I run this by you? Absolutely, please do so. We would love to help you. So we're more of like a resource and a consultancy and educational program that happens to do real estate versus other way around.
Thanks, Vikram. And I've got another question here from Robert Rosdan. He asks, and this could be generalized, but just says, can you talk a little bit more about the tax advantages of not just, I guess, he says your program, but I think of real estate in general. And then
I think overall, guys, that's why people love real estate, because you get tax advantages. It's hard to get tax advantages in stocks, right? You just make profit or loss and that's it. But in real estate, it's really advantageous. And so a lot of people who invest in passive investments, they get these paper passive losses that they can use to offset other income. And depending on your status, it could be used to offset active income, but most times it's really used to offset other passive types of income. And so if you have other businesses, other returns, other investments, it helps maintain tax efficiency.
Great. The next question is, there's a bunch, but I'm going to just kind of
just rapid fire. Let's go.
And of course, you guys can. There's a book a call button there, so if your question doesn't get answered, I apologize. You're more than free to chat with folks from Viking. So another question from Melissa is, what's the average hold period for investments before there's like a 2-time equity return?
Sure. There's the listed one where when we have an investment, when we launch it, we say 3 to 5 years. But on our 9 exits, it's been like pretty close to 3 years in where we exit. So we notice that we tend to exit earlier, but we offer people a longer hold period just because we want flexibility. Our goal is to maximize your returns. And so if it makes sense to exit in the 36th month, we will. If it makes sense to exit in the 40th month, we will. Like we want to pinpoint the right time to maximize returns for everyone involved.
Here's a great question. This is from Charlene Fry. It just she or he is asking, what are the metrics to look for in a great investment?
Yeah, absolutely. What I want to look for is, one, does it make sense to me? Do I understand it? Is it complex, or do I understand it? Number 2, what's the track record of the group, company, or entity that I'm working with? Number 3, what are the returns and how do I get them? Are they all back-ended? Is it all appreciation, or is it all cash flow, or is it a combination? Number 4, is there any other advantages besides the cash flow and appreciation? Is there tax advantages? Number 5, do they have a business plan if things hit the fan? Meaning, when there's instability, economy shifts, unemployment, whatever, And the final one, if I had to give a bonus, is this a one-man show or one-woman show, or is there a team? So if I can't get a hold of someone, there's someone else available to me, or there's other partners involved. So it's a whole. When I invest, I'm serviced well, meaning I'm taken care of. I have support. Those are the big ones.
Excellent. And then there's this is coming up in kind of various questions, but there's folks I think that have some equity maybe locked up in a retirement account, like a 401k. And they're just wondering, are there paths, or is there ways to kind of use that money for FIRE?
Absolutely. I had, like, in a lot of my physician employment history, I had all these like rollover IRAs, and I'm like, what am I gonna do with this stuff? I'm tired of putting it in like, Fidelity and like Charles Schwab, and I have 4 mutual funds to choose from, all of which suck. And so I'm like, all right, what do I do with this? And then a friend of mine told me, hey, you could use your 401k or IRA to invest in real estate. I'm like, really? How? And then he's like, well, what you do is, those are custodians, right? And you need to go to a custodian that does self-directed IRA. So there's so many out there, but there's some good ones we work with that are called IRA Club, and literally they can on your behalf request from Fidelity or Charles Schwab to roll over those funds. So they go from one custodian, which has very limited options, to what we call a self-directed IRA custodian, which has multiple options. You can invest in gold, crypto, real estate, anything you want, right? And not anything. Let me rephrase that. Not anything, but a lot of things you want, alternative asset classes. And you take that, and then you can invest. the money is obviously growing tax-free because it's probably a tax-free account, and they invest on your behalf, so they're the custodian of the money, and then the money goes back to that retirement account upon sale or whatever, and all the distributions go to that account too. So it's quick, it's simple, it makes sense, and it helps you deploy underutilized capital.
Thanks. Excellent. There's a question from Merlin. I had to scroll up for a little bit, but the question is, are there any pointers for oil and gas investments from
Yes, I like oil and gas investing. Here's the good, the bad, and the ugly. The good is that is the number one thing. If you're a W-2 earner and you really want a tax write-off, oil and gas investing is your jam, guys. What are the negatives? Well, a lot of times when you're investing in oil and gas, you're literally investing in one oil well or one sort of thing. There are a few companies out there. I think King Oil, they're doing something a little more interesting. Like instead of investing in just like one single family home or like one oil well, they're actually saying, hey, we have a collection of wells, a collection of land, collection of leases that you can invest in, and you have a higher likelihood of getting return. Most people who invest in oil and gas, they're doing it for the tax benefits. But if you look at the actual returns on their investment, it's not the greatest, right? It's okay. It's good, but not great. So I would say don't let the tax tail wag the dog. I think that's the way the phrase goes. Meaning you want tax and the returns, not just tax and sort of returns.
Excellent.
OZs, yes, I've looked at OZs. They used to be really big 2 or 3 years ago, not so much anymore. And the requirement to get into OZs is substantial. So let's say like we bought this $53 million deal, right? Or I'm sorry, $57 million deal. We're putting in probably $4 to $5 million of renovations in this thing, right? That's a lot. But if you have an OZ deal or opportunity zone deal, guess how much money we have to put in? We probably have to put in 20 million and literally like rip it down to the studs and rebuild the whole thing. And so the requirements are a lot more, and you have to do a lot, and there's a lot of hoops you have to go through, and you're doing it for tax benefits and returns and stuff like that. But the popularity of a lot of this has sort of phased out from what I've seen.
Excellent. There's a couple of people that are asking how to book a call. There should be a little button on.
Yeah, guys, check out there's an orange button. It should say book a call. Press that button, book a call. My team should throw in, hey guys, team, throw in your emails and phone numbers. Let people ping you, man.
I think that's populating there, but hopefully Dennis and a couple others who've asked, that makes it a little easier for you. There's some real savvy investors in the group here, Vic, and they're asking some questions about the exchange 1031 exchanges, if Viking has participated in that, or how they look upon some of those advanced tax strategies. You want to just talk about that a little bit?
First of all, whoever's asking those questions, well done, good job. Obviously, you guys are on your way to either achieving FIRE or you're already, maybe achieved it. So congratulations. I think you're an inspiration to a lot of the people who are coming in here to this webinar. That being said, yes, we do participate in 1031s. In fact, we're selling that deal, that deal I mentioned, Veritas. We're on point to hopefully sell it if we get the right pricing that we want. And when we do that, we're planning to 1031 that into another deal. That being said, we accept other people's 1031s if the number is high enough, because there's a lot of paperwork, as you guys know, with the 1031s. And so we want to make sure that it just makes sense for everybody involved. So if you're really interested, reach out to our team. We'd be happy to help.
Do you want to just talk briefly about what a 1031 exchange is and why it's so powerful?
Guys, some people in Congress and wherever who've created these tax laws, they create loopholes. And this is one of the most powerful loopholes on the planet for creating rapid growth, generational wealth. It's essentially when you sell a deal, you have a limited time period in which you can buy a like kind of deal and sort of what we call swap it in for another deal. So let's say you have a $100,000 house. You can now sell that house for $200,000 and now buy a house for $400,000 and use all the money from the $200,000 sale and invest into the $400,000 house, and it's all tax free. And then do the same thing again. The $400,000 house, you buy an $800,000 house, and at some point when you decide to sell for profit, that's when you have to pay the taxes. Now there's a strategy in the loophole where literally, let's say you keep owning until you pass away and you pass on to the next generation, then everything is reset and they don't have to pay any taxes. So you can imagine how powerful this is. And let's say you do this over 10 years and you have to pay taxes, you will have rapidly increased your trajectory and your velocity of money so quickly, because all the money that would have been paid in taxes is used to further propagate and compound. So that's why people love it.
Outstanding. I think we've answered a whole bunch of the questions, and I'm sure there's going to be more, but like you said, we'll be sharing the replay link. So there's some questions that are repeating, and take a look at the replay, and then I'll let you finish it up. But just on my behalf, thank you all for spending some time with us. I know the evenings are challenging at times, but we really appreciate you working with us and then listening to Vic and all he has to share.
Guys, thanks. You guys will get the replay of this. Please reach out if you need anything. Again, this is just a general informational webinar. If you need anything, please reach out. We just want to be a knowledge source or a resource for you guys in any way. Merlin, yes. Chris, please get with Merlin. She has things that we need to definitely talk to her about. So thank you, Merlin, for doing that. Yes. DJ, absolutely, we'll do that. Guerdy, absolutely, we can help you with the 401k. DJ, those deals where it's 8% cash on cash and 2x multiple deals, that time is coming, my friend. So buckle up and get ready. And I think that's it. All right, my friends.